Okay, welcome to Accounting 401, Taxes, Chapter 5, Gross Income and Exclusions. There was a Supreme Court Justice who once said, I forget his name, but he once said, he knows what income is, he knows what the exclusions are, he knows what deductions are until he reads the IRS code, then he's not so sure. A little bit of a exaggeration there, but gross income, the definition is it's an all-inclusive definition by the IRS. Everything coming in is income, and it's subject to tax unless it is specifically stated in the code that it is not subject to the tax. That's the exclusion part. Um, we'll get to deductions, I believe, in the next chapter. Okay. Now, misconception, maybe not so widely held, but years ago there was this big surge in barter clubs where people thought they could get away from uh, taxes. You don't have to be paid in cash. If you receive anything of value in exchange for goods or services provided to another party, it's income to you. Okay? So usually most people know what income are because they work for somebody else. If you work for yourself, then income is, this thing is hung up again. Commonly, you work for somebody. At the end of the year, you get a W-2. It says how much you made, and it's all well and good. If you're self-employed and you have to keep track, you have to keep your own books and records of what work you do or goods you provide your customers, clients, whatever. And if it's over $600, you're supposed to fill out a Form 1098. And that doesn't relieve you from, if you don't use that form, doesn't relieve you from it. You have to declare every penny that you received from others, whether it's in the form of cash or in exchange for other services or other goods. Okay, that's what they say here, income from services. Most people are selling their labor to their employer. Okay, earned income. There's all different types of income, passive income, earned income. So mostly what we're talking about for the vast majority of Americans is earned income, what we call W-2 earnings, working for somebody else, providing your services to somebody else. I provide my services to Misericordia University. Every 2 weeks, they make a deposit, direct deposit into my checking account for the pay they owe me. Under a contract, I'm supposed to teach 12 credits a semester for my base salary. If I do things over and above that, they have extra contracts for that. Sometimes we sell property, income from property, owning things, all right? Rents, okay? Selling capital assets, okay? Gains or loss from the sale of property, selling your home, selling your car, selling your golf clubs, having a yard sale, that's income. You see them all over the place on weekends around here. And every time I drive by on a weekend, I drive by 3 or 4 of them, and I see the signs, and I see the people out, and I'm wondering how much of that is going to be reported. Again, a lot of the individuals aren't aware that that is income to them and is reportable. And of course, they could take out the basis of the goods they're selling to get to the net income. But again, a lot of them are ignorant of the fact that that is income and it is reportable on their tax return. Again, one of the big pushes here with this new 87,000 new IRS employees, and I think the news media blows it out of proportion. I don't think all 87,000 are going to be agents. There's going to be a lot of support personnel in there. But one of the things is they want to start looking at all the business that is transacted by people selling stuff on eBay. And if you have over $600 sold, you're supposed to file forms. But even if you have $5 or $10 sold, you're supposed to put it on your tax return. All right. Again, you have interest, rents, royalties, annuities, up north of here with the oil, the Marcellus gas fields. People just we're lucky enough to have gas underneath their property. Company will come in, do all the work, and they get a royalty payment for everything that's extracted. Okay. Dividends, interest, rent, royalties, annuity, sale of property, sale of assets, all results in taxable, results in gross income. Okay. Very likely, all of those would be gross income. The only thing would be somewhat exempt on the sale of property, and we'll get into this later on in the semester. There's some exclusion on the sale of your principal residence if you meet certain occupancy and certain other rules. You can exclude up to, I believe it's $125,000 or $150,000 of the gain, not the whole thing. Okay. And again, please read the examples. They're very good in this book, a lot better than the ones you find in the IRS publications. An annuity. An annuity is just a fancy word for a series of payments. In this textbook, they're talking about investments that pay a steady stream. You can buy a contract with some brokerage firm or investment firm or an insurance company, plunk down $100,000, and they will agree to pay you $10,000 a year from age 50 to you die. So they're taking a gamble. You're taking a gamble. If you live long enough, you're going to make out. If you die early, they're going to make out. But again, how much of that is income? There's a formula there because you're actually paying for it and you're getting some back. So the formula is the exclusion ratio is the original investment divided by the expected value of the annuity equals the return of capital percentage. Okay, so every payment they pay you is going to be a return of your original investment purchase of the annuity, and some is going to be interest or capital gains or dividends that they earn and pay and distribute to you. Okay, two types of basic annuities, ones that are paid over a fixed period of time and ones that are paid over a person's life. Okay, so it'll be a fixed or a life annuity. 10 years, 15 years, or like I said, from age 65 until you die. Nobody knows when that's going to be. Okay, so the challenge from a tax perspective is to determine how much of each annuity payment represents gross income tax at ordinary tax rates, and how much represents a non-taxable return of capital. In other words, the non-taxable return of capital is how much of your original investment is in each payment. So, like I said, we'll plunk down $100,000 and they agree to pay us $10,000 for 20 years. Each of those $10,000 payments, a part of it is return of our $100,000 that we shelled out to buy the annuity. Part of it is income that the company, whoever we bought it from, took that $100,000 and invested it somehow, some way. That's our taxable amount. Okay, so the exclusion ratio, they give you the formula there, determines a portion of each payment that is a non-taxable return of capital. The remainder would be taxable ordinary income. Ordinary income is the phrase we use, that is income that is taxed at your ordinary rate. There are other items we'll talk about throughout the semester that get favorable or what we call preferential rates. Qualified dividends, long-term capital gains come right off the top of my head. There might be a few others. Okay, they have a table there for a expected return multiple ordinary single life annuity, and they have the age starting dates 68 through 72, and they give you a multiple there. And then they talk about how to calculate that out. The taxpayer receiving a life annuity who lives longer than his or her estimated life expectancy. Again, these are all things figured out by what are the people, the mathematic. He's my guy I used to work with. His daughter went to be an American actuary. Actuary, that's what it is. Insurance companies, investment firms hire actuaries. Very technical field, mathematic based, and they do all kind of factoring into. And insurance companies are big on this too, and not only investment firms. And that's what insurance is all based on, actuarial returns. They put a whole bunch of variables in and figure out how somebody living today at a certain age, what their life expectancy is. The IRS also uses some of these tables, and they have actuaries of their own on their payroll. So if you live longer than your life expectancy, you will receive more than the expected number of payments. The entire amount of these extra payments is included in the taxpayer's gross income because the taxpayer has completely recovered all their original investment. So everything else above that is the sort of say the icing on the cake. The icing is taxable. The cake is what you baked in and put into it, what you invested into it. So it's a return of your original purchase price. Again, the way to think of this is, put $100 in the bank at 5%. At the end of the year, you have $105. Well, your income is only $5 interest. The $100 is a return of your original investment at the beginning of the year. Property dispositions, pretty straightforward. The Exhibit 5.2 shows you the sales proceeds, less the selling expenses equal the amount realized, and then you subtract out the tax basis, and that gives you the gain or loss. If it's positive, it's a gain. If it's negative, it's a loss. Now, what is tax basis? Usually tax basis is what you have invested in the property, less any, if it's business property, less any depreciation. Okay. And again, there's various bases that you can do. For instance, there's a big misconception that parents always, when they're old, they want to sell the homestead, family home, to the children for $1. Well, if the children have their own home, they're going to turn around and sell the homestead for, let's say, $500,000. Then they're going to have a gain of $499,999. If, however, the parents are smart and contact a good tax accountant or lawyer, and they will advise them, don't sell the house to the children. And again, a lot of people do this to protect the house from attachment for the nursing home costs. You let the house go to the kids via the will, because then you get whatever the fair market value of the house is at the date of death. So let's say the house was worth $450,000. The kids have their own house. They sell that for $500,000. Their gain is only $50,000. What would you rather pay tax on? $499,999, going to be a pretty hefty tax bill. $50,000 gain, you're still going to pay tax, but not nearly as much as you would if your basis was $1 versus basis being $450,000. Okay. Now, the thing that kicks in with the sale of assets are how long you hold it. If you hold it longer than a year, you get preferential rates under the long-term capital gains treatment. If it's held a year or less, it's considered a short-term capital gains, and it is taxed at ordinary rates. Okay, so the holding period is an important decision when you want to sell something. Okay. You can deduct losses from property dispositions depending on whether they are used as assets, using for a business, investment purpose, or personal purposes. Okay. Long-term capital gains, tax at preferential rate. Deductions for net capital losses realized by individuals limited to $3,000 per year to offset ordinary income, carry forward indefinitely. So if you have $30,000, you can take $3,000 in short-term capital loss. You can take those $3,000 deduction against ordinary income for the next 10 years. And of course, you offset the net capital, short-term capital loss against short-term capital gains. There's a netting process that we'll get into. Key facts there. Taxpayers are allowed to recover the capital investment invested in the property they sell, and that's a return of your investments. It's a non-taxable event. Payments from the purchase annuities that are part income and part return of capital. Okay. So you have to cut that out. How much is a return of your investment? Non-taxable. Anything above that is a taxable gain. When property is sold or disposed of, the realized gain or loss equals the sale proceeds reduced by the basis of the property. Yeah, we saw that in that formula and in the examples. They give us some other sources of gross income. Income earned from wages or having a business, a property, unearned income such as dividends or interest. So again, earned, you're working for it, or you're in the business of doing that, a plumber, electrician, what have you, an accountant. And then you can sell property or you can lease property and get rent on it, get lease payments on it, royalty payments, and then interest and dividends on investment. Non-earned income, passive income. Okay. Income from flow-through entity is a ownership stake in a partnership or in a subchapter S corporation or LLC, limited liability company. Those entities file informational tax returns only. They do not pay tax. The tax is paid on the owner's individual 1040. That's why they're called pass-through entities. Okay, flow-through entity or pass-through entity. Again, we could be 50-50 partners in a partnership, but you work full-time in the partnership. I'm only a investor in it, the money person. And so we might have an arrangement where you get more of the earnings because you're working in it and own half of it. I only own half of it. I'm not working in it. So even though the company makes $200,000, we could split it 50-50, 100,000 for you, 100,000 for me. But more likely, if you're working in it, you're going to get 150. I'm going to, part of it is compensation for the work you do. Part of it is compensation for your ownership stake. Mine is only compensation for my ownership, my investment. Different types of income are treated differently, and the same thing with the deductions. So these are things we have to be aware of, and we'll talk about these throughout this course. The partnership in subchapter S LLCs, they have to file, not only file a form with the IRS and the informational return, they have to show each owner's share of the income earned, and that comes through on a K1, Schedule K1. For a partnership, it's a K1-1065. The 1065 is the partnership return. For the subchapter S, it would be a K1-1120S, which is 1120S being the information return for a subchapter S corporation. The LLC has the option of being taxed as a partnership or a corporation. Alimony, going to be a moot point after a number of years because the change of the tax code. If you look right there on page 515, the tax purposes transfer between the former spouses represent alimony only if it meets the definition. For any divorce or separation agreement executed before January 1, 2019, if a payment meets the definition of alimony, then the amount of the payment is included in gross income of the person receiving it, and it is deductible for AGI by the person paying it. Thus, the alimony shifts from one spouse to the other. Income shifts income from one spouse to the other. In contrast, for any divorce or separation agreement executed after December 31, 2018, alimony payments are not included in the gross income of the person receiving the payments and are not deductible for the person paying it. So that's a very important date, or very important two dates, January 1, 2019. Before that, it is income to the receiver, deductible to the payer. After December 31, 2018, it is not deductible and it is not income. So, big change in the tax code there. There are other types of payments that do not qualify as alimony, such as property division, who gets a car, house, or cat, and furniture. Child support payments. It's not income and it's not deductible. Okay. In any event, if the transfer of property between the spouse does not meet the definition of alimony, the recipient of the transfer excludes the value of the transfer from income, and the person transferring it is not allowed to deduct it. Okay, that's if it does not meet the definition of alimony. Prizes, awards, and gambling winnings. This becomes a big thing since we legalized gambling in almost every state of the union now. It used to be only Las Vegas, Nevada, and Atlantic City. Las Vegas goes back to the 1920s or 30s, I guess, 40s. Atlantic City, I guess, was back in the 70s or 80s, and now we have it almost every state of the union. Prizes, awards, and gambling winnings, such as raffles or sweepstakes prizes or lottery winnings, are includable in gross income. Now, Pennsylvania, if you win on the Pennsylvania lottery, it's excluded from Pennsylvania tax, but it is subject to the federal income tax. Okay, if you go on Wheel of Fortune and win the prize or win anything, it's taxable. Okay, there's a few exclusions to these things, so you have to be careful. Three specific ones. First would be awards for scientific, literary, or charitable achievements, such as a Nobel Prize, gold medal at the Olympics, but only if the recipient was selected without any action on his part to enter the contest or proceeding. 2, the recipient is not required to render substantial future services as a condition to receive the prize or award, and the payer of the prize or award transfers the prize or award to a federal, state, or local government unit or qualified charity, such as a church, school, or charitable organization designated by the taxpayer. Okay, the obvious downside is the recipient does not actually get to keep the award, the cash award, or the prize. However, for tax purposes, more beneficial for the recipient to exclude the award from income entirely by immediately transferring it to a charitable organization than it is to receive it and then donate it, because then it is only an itemized deduction and there are subject to limitations on that. All right. Second exception is for employee awards for length of service or safety achievement. These non-taxable awards are limited per employee per year to $400 of tangible property other than cash equivalent, gift cards or gift coupons, certificates. If they give you a watch after you get 20 or 25 years on the job, as long as it's a watch of $400 or less, it's a gift. It's not taxable. If they give you a Rolex Daytona worth $25,000, I guess you can exclude the $400 and pay tax on the $24,600 remaining value of the Rolex. All right. Meals, lodging, vacation, tickets to sporting events, stocks, bonds, other security of similar nature. Award is not excluded from the employee's income if circumstances suggest it is disguised as compensation. Okay. Again, the IRS, Congress writes the law. They write them in their favor. The third one, narrowly defined exception, is for the value of any award, medals, and prize money received by Team USA athletes from the U.S. Olympic Committee on account of competition. I believe the gold medals they give at the Olympics, I forget what it was, somewhere. It used to be $12,000. I think they're upwards of maybe $20,000, $30,000 because they are gold, and then bronze and silver. Silver's worth something. Bronze, I'm not sure the value of bronze. I'm sure it has a value, but it's not up there with silver, which is not up there with gold. And again, platinum beats the both of them. However, there is no limit on the exclusion amount, and the exclusion does not apply to taxpayers for any year in which the taxpayer's AGI exceeds $1 million, $500 if you're married filing joint. So if your AGI is above a certain amount, and you don't get to exclude that. And again, it's a very narrow exclusion. Taxes and reward. You want a brand new car. Well, the price is right. Add insult to injury, the taxes are paid on the manufacturer's suggested retail price of the car, not the value that might be negotiated at the dealer. Okay. So you go on a game show, you win, it's taxable because you're doing something to win that. Taxpayers must include the gross amount of their gambling winnings for the year in gross income. Now you can, if you itemize, you can deduct your losses. So if you win 10,000, but it costs you 8,000, you only pay tax on 2,000. If you win 10,000 and it costs you 15,000, you're in a loss. You're not allowed to deduct the loss, but you don't have any income because it cost you more to win the 10,000 than 10,000. There are a few exceptions. There are some people who file their returns as with the Schedule C, claiming to be professional gamblers. So, anything they have associated with any expenses incurred in generating, winning their prizes, their games of chance, what have you, would be deductible. For professional gamblers, however, losses and related expenses are deductible to the extent of winnings. Okay, so you can have a loss, but you can reduce it to zero. Or if you want to have $1 million, you can maybe reduce it $20,000, $40,000, $50,000 and only pay tax on 450 some thousand. Now look at this one on the ethics. You find $100 on the beach while on vacation. Nobody saw you find it. Guess what? It's taxable income. You found it. It's income to you. Not many people. No, I don't think anybody except maybe I would declare it. Social Security benefits. That has changed over the years. It used to be exempt. Now it is taxable in certain circumstances. You may have to include up to 85% of your Social Security in gross income. And again, first step is determining gross income, then adjusted gross income, and then taxable income. Keep that in mind. And how much of that is taxable depends on your AGI. Some of it is exempt for lower income people on the lower part of the income scale. Their Social Security is not taxed at all. So they can rate single taxpayers. Let's see, taxpayer can be summarized. If modified adjusted gross income plus 50% of your Social Security benefits is less than or equal to 25,000, your Social Security benefits are not taxable. There's a table, and the software figures this out for you anymore. There's on the page 1 of the 1040, you'll have your gross Social Security benefit, and then over you'll have the taxable amount in the right-hand column. If $25,000 is less than your modified AGI plus 50% of Social Security benefits, but less than or equal to $34,000, the Social Security benefits are taxed at the lesser of 50% of your Social Security benefits or 50% of your modified AGI plus half your benefits. And thirdly, if your modified AGI plus 50% of your Social Security benefits is greater than $34,000, taxable Social Securities are the lesser of 85% of the Social Security benefits or 85% of the modified AGI plus half of your Social Security benefits, less the $34,000. So yeah, it sounds complicated, but it's not if you take it step by step. And like I said, the form, it can walk you through it, doing manual computations, but all the software, all you'd have to do is plug in the numbers. They know these rules are embedded in the software. Just plug in the numbers, taxable. Then they have a different set of limits for taxpayers married, filing joint, and give them a little bit of a break. And they give you examples to go through there of different variations. Imputed income, besides receiving direct income like wages, interest, and whatnot, you could have imputed. Bargain purchases. A lot of companies allow their employees to buy their products at a discount. Well, if the discount is greater than a certain amount, it is considered income to you. Ford, I know, I don't know the percentage, but I know some people who work for Ford or had relatives work for Ford would buy a car and then resell it to them, and they'd get, a nice discount. So here, up to 20% employee-provided discounts on services, discount on employer's goods as long as the discount does not exceed the employer's gross percentage profit. So the markup, you got to know what that is to determine whether it's taxable or not. They give you an example there. The example 19, Wood Granny, got the architectural service as part of a compensation package. They did some work and they were valued at $35,000, but they only charged you $22,000. And they say the cost of the service is $22,000. Discount on service was 13. Excludable discount 20%, $7,000. So some of that generated taxable or gross income. Okay. Below market loans, forgiveness of debt. If you owed somebody some money and you're paying a loan off with a family member, a relative, or next door neighbor, you borrowed $10,000, and they hit the lottery and they've got you still owe them $2,000. They say, forget the $2,000. I hit the lottery. I don't need it. Happy to share my good luck with you. That $2,000. The forgiveness of that $2,000 debt is reported as gross income to you because it would have you benefited. Okay. Discharge of indebtedness, we just talked about that a little bit premature before I scroll down. Again, the key facts, be sure you read each one of those. Page here. Exclusion provisions, non-recognition. Sometimes you can, again, there's a difference between excluding something, meaning it'll never be subject to taxation, or deferring it, meaning something's happened, but you can put off recognizing reporting the tax until a future tax year. Deferral. Exclusions are a lot better. Deferral, sooner or later, you're going to have to pay it. You don't know what rates are going to be in the future, and you do know that probably the purchasing power of the dollar is going to be eroded by inflation. That's a basic strategy to defer it as long as possible because you're paying it off with cheaper dollars. But again, on the other hand, you don't know what the rates are going to be. You don't know what tax bracket you're going to be in. All right. Common exclusions, municipal interest on municipal bonds. The Congress and IRS figured it's a good thing to have municipalities, local governments be able to raise money for various endeavors by selling bonds to the public, but to give them a break, they can have a lower rate on those bonds and it'll be tax-free. So the investor will buy a 3% municipal bond if they're in a high bracket and be better off than if they had a 5 or 6% corporate bond, because the 3% is tax-free. If you're in a high bracket, you get 5%. You don't have the 50% bracket anymore, but if you did, let's say you got a $5,000 interest on your bond, corporate bond, $3,000 on a municipal bond, the corporate bond tax at 50%, you only get $2,500. With the municipal bond, the $3,000 gross, $3,000 exempt, you get the $3,000 no tax. Gain on personal residence. I alluded to this a little bit earlier. Now we can see what the numbers are. We can exclude up to $250,000, $500,000 if married jointly of the realized gain on the sale of the property. That's not the gross proceeds. That's the gain. Okay, gain in the excess of the exclusion generally qualifies as long-term capital gains. And to satisfy the use test, let's see, you must have owned the house, and again, a house, condo, trailer, or a houseboat. As long as a houseboat has a kitchen and a bathroom on it, it's considered a resident. Now, is it your principal residence? You have to have lived there. Ownership test. You have to also have owned the residence for a total of 2 or more years during the prior 5-year period, ending on the date of the sale. And they give you some exclusions on this if you have it and then you had to move, or you were in the military and you got transferred. Let's see. It limits each taxpayer to 1 exclusion every 2 years. Married couples following. Either spouse can meet the ownership test, and both spouses must use the principal use test. Okay, so there's ownership and a use test. To satisfy the use test, you must have used the property as a principal residence for up to 2 or more years during the 5-year period. Ownership test is pretty direct. If either spouse is ineligible for the exclusion because he or she personally used the $250,000 exclusion on another home during the 2-year period, the couple available exclusion is reduced to $250,000. Again, they give you examples to watch to give you some better understanding of it. I take the time and read those once or twice. Fringe benefits. Some are taxable, some are excludable. Again, things that Congress deems in the public good, the public interest, they're going to exclude. They like healthcare, so healthcare is excluded. Life insurance is a good thing, but they put a limit on it. I believe it's over, $50,000. So they list them in Exhibit 5.3. So let's take a quick rundown there. Medical and dental health insurance. An employee may exclude from income the cost of their medical. So sometimes you're better off if you have good coverage to take a little bit, take 50,000 instead of 55,000, and take the rest in medical because medical insurance running 12, 15,000 a year now. Life insurance coverage can exclude the value up to $50,000 benefit. So if you have a $100,000 insurance, a life insurance group with your employer, half that premium is going to be considered tax. Half is going to be excluded. De minimis benefits. De minimis is Latin for small amount. Meals and lodging for the employer's provided convenience. So if it's for the convenience of the employer, having you live in a place, it's you can exclude that. The president of the university has a house provided for him and his family because he's expected to do a certain amount of entertaining and have meetings. So it's part of his compensation package, but it's excluded. Okay, the former president lived in that house, but he also had his own personal residence out at Harvey's Lake. Current president, I think he's living in the house and that's his only place of abode. Employees' educational assistance programs. Employees may exclude up to $5,250. And again, a lot of these numbers change with time. So don't focus on the numbers, focus more on what it is, the benefit. A lot of places will, if you get a C or a B or better, they will pay your tuition up. Well, if you're going full time, you can exclude up to $5,250. Anything above that is going to be taxable or going to be in gross income. No additional cost services. Some employees are providing, counseling, psychological counseling, legal access to a law firm or lawyers. Dependent care benefits up to $10,500. A lot of employers giving daycare to their employees. Okay, for children under 13 though. Okay. And again, it's children under 13 or a dependent over 13 who has a physical or mental disability. Working condition fringe benefits, employee uniforms, okay, safety shoes, safety equipment, qualified transportation benefits. Employees may exclude up to $270 per month of employee provided parking and up to $270 a month of a combined value of employee provided mass transit passes. If you have a company car, it is going to be it's going to be included on your W-2 based on the value of the car. So you think, hey, this is good, you're not paying for it, but you are getting, and again, it's cheaper than buying a car and using it, but it's still compensation to you. Cafeteria plans, there's some rules we have to know about that, where you can pick and choose off a menu of fringe benefits. Benefits are tax-free to the extent the taxpayer chooses non-taxable fringe benefits and taxable to the extent that they receive cash. I'm old and I'm on Medicare, so I don't need the Blue Cross Blue Shield that the university provides its employees. Because of that, every other pay, they give me a stipend of $25. I'm saving them $15,000, $20,000 a year, and they're paying me, let's see, $600. Yeah, that's fair. Yeah, it does matter. Flexible spending accounts. This is where you can set aside part of your W-2 earnings into a savings account to be used for, or the employees may match up, contribute some of it. And there's limits on it. Medical expenses are limited to $2,750, and dependent care expenses $5,000. In addition, employees offer retirement plans. Anything they take out of your paycheck, let's use a university, or I could use my prior employment with the Commonwealth. Uh, 6.25% or 6.5% of my paycheck when I worked for the state would go into my retirement. The state would match that amount or make a contribution towards it. Okay, that would be tax deferred. I would not have to pay tax on that amount that they took out of my paycheck because I'm not touching it. But now that I'm retired and I'm receiving a pension, some of the money I put in came back. That is now being taxed as I take it out. With the university, they have a rule where you can contribute between 6 and 8%, and they will match it. And if you go with the max, they add another 1 or 2% to it. All that is going to be tax deferred. I don't pay tax on my contribution currently. So let's say my paycheck is $50,000. Gross pay for the year is $50,000, and I make $2,000 in contributions to retirement plan. My W-2 will say gross compensation $50,000, taxable $48,000, because that $2,000 putting in that I put into the that they withhold and put into the retirement fund for my benefit will be taxed when I start taking that out. Same thing with their contribution. They're putting in 8% of my base salary. It's not taxable to me. It's a benefit, but when I start pulling it out, I will be taxed on it. So it's a deferral. I had not only when I worked with the Commonwealth of Pennsylvania, did I have the pension that I had to put 6.25% or 6.5% in. I forget what it was. Towards the latter part of my career, they came out with a deferred compensation plan because of tax law changes, and I was able to put in contributions to that, which would also lower my current taxable payroll earnings. But now that I'm pulling some of that money out in retirement, it is now taxable at ordinary rates. Later on, we will talk about IRA accounts, traditional and Roth. And when we get there, we'll talk about it. We don't want to spend too much time talking about those right now. Employee expense reimbursements. When I worked as an auditor, I traveled all over the country. I was in 27 states. And the Commonwealth they had guidelines, and I was allowed so much a day for 3 meals when I was more than 50 miles away from home or staying overnight. And I mean, I was out to San Francisco, up to Boston, down to Oklahoma, Chicago, all over 48 contiguous, never got to Hawaii or Alaska. They would reimburse me. I'd make a hotel reservation. I would use my credit card, and airplane flight out there, rental car out there. Those are all expenses. They would reimburse me dollar for dollar. So it's not income. They're reimbursing me what I actually put out. Some places would pay people a flat fee, and if you want to stay in a flea bag motel or you want to stay in a 5-star motel, it's up to you. So again, they would be if it's an accountable plan, let's see, if an employee is required to submit documentation reporting expenses and receive reimbursement, and the employer reimburses only legitimate business expenses, and the employer's reimbursement plan qualifies as an accountable plan. Under accountable plans, the employees exclude the expenses from gross income. Yeah, it's not income. I'm getting paid back for what I shelled out. Okay. Let's see. If you do not have submit documentation, the reimbursement is considered taxable compensation, and the employee is allowed to deduct the expenses as employment related. Okay. The last sentence there, employees really favor accountable plans because it lessens your tax keeping records requirement. Have phone, we'll call tax free. Okay, a lot of people, you're getting a cell phone. How much? Let's see. IRS considers employee issued cell phone as excludable fringe benefit for both the business and personal use when the phone is provided primarily for non-compensatory business reasons. Even better, the IRS does not require record keeping for it. So, again, that could be de minimis type of a fringe benefit. Education-related exclusions, scholarships. College students seeking a degree can exclude from gross income scholarship, including Pell Grants, not loan, grant, that pay for tuition, fees, books, supplies, and other equipment required for a student's course. So if they require you to have a computer, or they require you to have a set of scalpels for dissecting things in a biology lab, if it's required, then it qualifies as an expense, and anything supporting that is excluded. Scholarship exclusion applies only if the recipient is not required to perform services in exchange for receiving a scholarship. Okay. What about athletic scholarships? Good question. IRS ruled that the value of athletic scholarship is excluded from gross income if it is awarded to students by a university that expects but does not require the student participate in a particular sport. You quit the team or you get hurt. And 2, requires no particular activity in lieu of participation and is not canceled if the student cannot participate. Okay. Like other scholarships, athletic scholarships are only excludable from gross income to the extent that they pay for tuition, books, fees. Anything above that would be income. Okay. Any excess amount, room and board, is taxable. Okay. Other educational subsidies. The 529 plans, you can defer or exclude income of the Cloverdale education savings accounts, as long as they're used to pay for qualifying educational expenditures. Now, what would that be? It would usually be a school of an accredited body. It could be a trade school, could be a college or university, could be a private high school. Students seeking college degree can exclude scholarship that pay for required tuition, fees, books, and supplies. Taxpayers can elect to exclude interest earned on Series EE savings bond when the redemption proceeds are used to pay for qualified higher education expense. The exclusion of interest on Series E is restricted to taxpayers with modified AGI specific limits, and those limits will change from year to year. Okay. And you can read through those on the subtitles under the blue headings. Exclusions that mitigate double taxation. Okay. Gifts and inheritance. Individuals may transfer property to other taxpayers without receiving or expecting to receive value in return. These are the transfer taxes. If the transferor, the person giving it, is alive at the time, it is called a gift. Okay. If a person giving it is deceased at the time of the transfer, it is an inheritance. Okay. These transfers are generally subject to federal transfer tax, but there are amounts below which you don't have to pay tax. Okay. And they change from year to year. In fact, the one's about to run out. The one was put in by the second President Bush. I believe it's $12 million federal estate tax. Yeah, very few people qualify for that. Let's see. You are. We'll talk about this later, I guess. The gift tax, I think it's $15,000 per person per recipient. Life insurance proceeds, in some ways, are similar to inheritances. The owner of the life insurance policy dies, beneficiary receives a benefit. Decedent is generally subject to estate taxation on the amount of the insurance proceeds. In order to avoid potential double taxation on the insurance proceeds, the tax law allows the taxpayer receiving the insurance proceeds to exclude the proceeds from gross income. So it goes into the estate, it's taxed there, but when it's distributed, it's not taxed. However, when insurance proceeds are paid over a period of time rather than in a lump sum, the portion of payments represent interest and must be included in gross income. And sort of like the annuity thing. What happens if you cash out a policy before death? Tax treatment varies based on specific facts. Someone cancels life insurance plan, pay the policy's cash surrender value, as you would recognize ordinary income to the extent the proceeds exceed what they have paid in premiums. What you paid in premium, is recapture of out of the proceeds. So again, if it cost you $50,000 over so many years you're paying premiums, and you get a $75,000 cash surrender value buyout, you only pay tax on the $25,000 difference. The gain, because the $50,000 is your money coming back to you. Accelerated death benefit is not taxable. If you want to take it out to, if you're in hospice care, you need funds to pay the hospice or nursing home, then it is not taxable. Foreign earned income, taxable. Now there's treaties and there's, again, you got a double taxation because you may have paid it in the foreign country. You can get it in two ways. You can either take the credit against the tax you paid in the foreign country, or let's say provide economy allows to exclude foreign earned income up to an annual maximum amount. And again, those amounts change from time to time. Currently, 2021 was 108,700. And rather than claim this exclusion, taxpayer may deduct foreign taxes paid as itemized deductions, not limited to the 10,000 limit on taxes as itemized deductions, or they may claim the foreign tax credit for foreign taxes paid on foreign earned income. Again, believe it or not, the code is somewhat fair. You avoid double taxation. Sickness, injury-related exclusions. Again, workers' compensation. Unemployment compensation is taxable. Workman's compensation, if you're hurt on the job, is not. Okay? And they said that on that last sentence there. Payments associated with personal injury. Physical injury, including payments for past, current, and future lost wages, are excluded from gross income. And the tax law specifies that any compensatory damages on account of physical injury or physical are not taxable. Okay, compensatory. Contrast, punitive damages are fully taxable. So if you get a $3 million award and $1 million is for lost wages compensation, that's exempt. But the $2 million that is punitive is taxable. And again, they'll give you examples there. In example 530, healthcare reimbursement. Any reimbursement the taxpayer receives from health or accident, pay for medical expenses, is excluded. Disability insurance, it depends on how you paid for it. Okay. Disability insurance, sometimes wage replacement, pays the injured individual for wages lost when they miss work due to injury. If the individual purchased the disability directly, the cost of the policy is not deductible, but any disability payment benefits are excluded from gross income. Okay, it may also be purchased on the behalf of you by your employer, and then anything, it sounds like it will be taxable. Employment allow employees to choose whether their premiums paid on their behalf be considered taxable compensation or non-taxable fringes. If the premiums are taxable compensation to the employee, any payments are excluded. If the premiums paid for the employer are considered a non-taxable fringe benefit, the employee must include the disability payments in the gross income. Little tricky there. Depends on how it's structured before you get any payments from the disability insurance. Again, the examples there will clear up a lot of situations. Deferral provisions. Installment sales. Okay. So when the taxpayer receives a series of payment over time greater than one tax year, how do they handle that? Well, you can look at it. Turn the page here. Scroll down. Hold on. Bear with me. God. Again, deferral puts off to a future tax year, but it does not. It's not an exclusion. Like-kind exchange, you just reduce the basis or I shouldn't say reduce, you adjust the basis of the asset acquired. You don't recognize a gain or loss on the asset exchanged if it's a similar asset. And again, there's some leeway. You can trade in a car for a truck or things like that. You can't do a car for a piece of real estate. That's not a like-kind exchange. If it's a like-kind exchange, you just adjust the basis of the property being acquired for any gain or loss on the property given up. And what it's going to do is it's going to defer it until that property is disposed of in a taxable event. Involuntary conversions, contributions to non-Roth IRA accounts. Income summary. This is for Courtney in the storyline. It shows all the types of income she had, and it shows an excerpt from the pay on the 1040, and then her Schedule 1 that supports line 8 on her 1040. And then they have grams, a summary of grams income. And again, Gramps died, the insurance proceed is exempt for her. And that brings us to the end of the chapter. So thank you very much. And again, we'll look at the learning outcomes, or the learning objectives before and look at the key terms, and then have at the assignments as per the syllabus.